Good morning. Well, it's absolutely true. There's a lot of, I guess, bifurcation in the market between technology and just about everything else. But usually what I like to remind all of our clients is that the reason that technology has been working so well this year is because earnings and revenues have been predictable in an unpredictable world. So like you were saying earlier, even though there's some uncertainty about what might happen in China with respect to Apple, or how far and stretched it might appear some of these technology names have become, at the end of the day, these companies have earnings and revenues that are sustainable, they're visible, and the market is rewarding that because there is still a lot of uncertainty. There's still elections to get through in the US. There's still economic uncertainty. And so these sort of secular growth themes continue to work. And we continue to advocate to our clients to stick with what has been working. Even though some of the value names that need to work in breadth, that needs to broaden in the market, can take the torch for overall leadership, the areas that have been working need to still work. And within information technology, there's still a number of areas that have lagged the broader sector. So while software and semiconductors have done incredibly well coming out of this pandemic and the work from home environment, certain areas like IT services, credit card processors, a lot of those companies have broadly lagged both the sector and the market and still provide a lot of opportunities and give you that exposure to an economic reopening, but still provide some of those secular growth tailwinds.
Matt, one of the issues I have with the sector is the amount of regulation. So there's single name exposure or risk, in my view, if you look at some of the European regulations coming into the mix, not to mention the US as well. Then when we talk about the problems with China, also single name risk exposure. So what do you do here? Do you just spread the bets wide?
It's absolutely true. There's a lot of risk, and as a lot of these names continue to become a little bit more stretched, the single stock risk does increase. And so as we build our portfolios and as we talk to our clients, there's an importance of having diversification in your portfolio. So you want to continue to hold a lot of these names that have been working where there is still arguably regulatory risk, but you want to be adding in some of the names that broaden out that exposure so that you're not exposed to just one or two single themes in your overall portfolio. And in addition to that, when you look at the overall regulatory picture, at least in the US, there seems to be a lot of bluster, but it's uncertain what is actually going to come from that. And as a result, it's the visibility into the earnings that continue to be rewarded. And when you look at the low interest rate environment that we have here, it's a very, very powerful force. And being invested in these companies that can continue to provide capital appreciation for your portfolios. Some of these companies are also providing dividend income and dividend growth. Those are also very important considerations as you look at including some of these names in your portfolio.